All attendees are in listen-only mode.
Good afternoon, welcome to today's Premium Account Short Form Market Update. Any individual reading or listening should discuss with their financial planner or advisor the merits of any recommendation offer presented in this material for their own specific circumstances and realise that not all investments are appropriate for every individual. Presented today, myself, Leon Hine, current Managing Director of Global Equity Management, the Investment Manager for the Investor Signals Unit Trust. I have 17 years of experience in the financial services industry and a licensed securities advisor. The format for today's presentation, it is a short form webinar, so we do a quick summary of global macro outlook. We look at the top 50 stocks in light of option expiry tomorrow, and we tie that in with the financial year 14 earnings per share outlook on some of those names in the context of portfolio allocations and our shorter term market outlook. The services that we provide are up on the screen there, and if you'd like to know more about those, please contact either myself or Christine, info@investorsignals.com. Up on screen is a graph of the XJO, and at 15 times forward earnings and trading at about a 4.5% yield, the market is expensive, but given that we've got this global macro backdrop of low bond yields, and obviously domestically we have the RBA setting cash rates at 2.5%, and on the basis that central bank policy will remain supportive for equity markets, we see global GDP picking up over the next 12 to 24 months, excuse me, which will be supportive for equity valuations. The German business optimism rose for the 5th month in a row in September, so I think that adds weight to the discussion that we had last week about Europe slowly recovering and at the margin helping to provide better data there coming out of China. US consumer confidence declined a touch, and I think that probably leads to concerns, I guess, that the recent improvement in jobs may not be sustained, especially over the coming months when we've got the upcoming budget negotiations, which will probably weigh on equity markets a little. Case-Shiller US Home Share Price Index growth was at the fastest in 7 years at 12.4%. Jumping to the mortgage rate in the US, this is a graph of the 10-year treasuries. I looked at this last week. I'd spoken at around 3%. Probably if it was to push above that, it would be negative for equities. We're starting to see the yield on the 10-year treasuries in the US retrace. I think that ties in with this issue around the budget negotiations. Also the fact that the Federal Reserve saw that the US economy was not meeting the growth milestones for it to pull back on its bond buying program. That's been a little bit negative for the US dollar. The flip side of that is obviously we've seen the Aussie dollar rally off its lows. I think whether the RBA sees that as enough of a reason to cut in November, I think they'll probably leave rates as they are, just as there may be some concerns around the recovery here or the growth in the Australian housing market, trying not to inflate a bubble too early in the housing market. So I think the RBA will probably suffer a slightly higher currency for another quarter and maybe review rates in the early part of the new year. That's had some implications for some stocks that we cover in our portfolio, and I'll talk about that as we get into the individual names. But broadly, I think that we're probably pretty close to the bottom end of the rate cycle here in Australia, and I'd expect the Aussie dollar to sort of find support at or near this 90-cent level and track sideways. Moving straight into a graph of the first stock that we're going to cover in today's recording is Amcor. So obviously we like this name. I think from a valuation standpoint, the stock trades at about a 4.3% dividend yield, should grow earnings around 8 to 10% into the next 12 months. We like it down here at around $10.20, at around $11 to $11.25. I think it's pretty expensive. I don't think it supports an argument on a yield much below 4%. We are delivering this in some cases where we own it at lower levels into option expiry tomorrow at around $10. If you allow for what we collected in the premium there, we're getting an effective exit price pretty close to where we are in the market. We would probably look to roll some of those funds over and reset positions in Amcor and keep an exposure ahead of the upcoming split. So we continue to like Amcor. Another name in tomorrow's option expiry that we'll have positions set over is BHP. Again, we own it at lower levels. We're predominantly sitting around the 37.50 level, so those positions will expire, and we'll look to reset that probably into the early part of New Year. We think on a valuation basis, BHP is probably due some upgrades given where spot iron ore prices are and petroleum and holding up at reasonably elevated levels. I think it should bode well for BHP to deliver probably close to 15% EPS growth in the 12 months ahead. I think that supports a valuation closer to around $37 to $38. If we tie that in with a gradual pickup in global GDP into the early part of New Year, we could see BHP pushing up to around $38, $39. Also in option expiry tomorrow we have BXB, and this again is a position where we own it at lower levels. We're predominantly capped out at around this $9 level to $9.25. I think when you consider it on a valuation argument, the stock trades about 16 times 2014 earnings. It delivers about a 3.5% dividend yield. It's another one of these names where we've got a spin-off coming up this side of Christmas, being the recall assets. I think that'll help to unlock some value for Brambles shareholders. We're still bullish Brambles, especially on the back of this currency play. We think the Aussie dollar probably is pushing up against the high end of its range at the moment, but still at the margin, these US dollar earnings converting back to a lower Aussie dollar should continue to support high single-digit earnings growth for Brambles. So to the extent that we end up delivering any of Brambles in tomorrow's option expiry, again, like Amcor, it's one of these names where we would roll back into new equity positions, reset that call a little bit higher up at around that 950 level into the early part of the new year, hopefully participate in the spin-off of the recall assets, would sell those shares, and continue to keep an exposure to Brambles in portfolios. Also, in option expiry tomorrow, we have CBA, and let's just jump to a graph of that. So a valuation that's clearly the more expensive of the banks. It's gone ex-div $2 a few months back. So we're coming into a period where ANZ, NAB and Westpac are the next dividend payers. So we've seen money rotate out of CBA, and we've seen NAB, as an example, significantly outperform. On a valuation basis, I think CBA trading, as I said, around 15 times earnings on just over a 5% dividend yield. Our expectation is that it probably largely tracks sideways, but as we get into that December period, expect to see a bit of a rotation back into CBA for the next round of dividends. From our standpoint, we own it at lower levels. We collected the $2 dividend, and we collected about $1.50 of call premium for this. So at a $72.50 strike, we're effectively getting an exit price of around $74, and that's provided a very good return for us for a short number of months, about 4 months exposure there to CBA. Also in option expiry tomorrow, we have Coca-Cola. In the case of Coca-Cola, we've seen the share price pull back a little bit following the earnings downgrade that the company delivered. I think all the negative news is sort of baked into the share price here for Coca-Cola, trading at about 16 times next year earnings on a 5% dividend yield. I think we're looking at support valuation here for Coca-Cola. I think what we'll start to see is more commentary out of the company about small bolt-on acquisitions and cost cutting, and I think at the margin that'll lead to a re-rating in Coca-Cola where we should see the share price track back up towards $13. As the price pushes back up to around $12.75, we'd look to reset calls in around this $13.50 level. For new money that's freeing up, we're continuing to acquire Coca-Cola at or near these levels. Also, tomorrow option expiry, we have Origin. Now this is an interesting Origin. From a valuation standpoint, the stock's getting pretty expensive up here. We have the stock trading on numbers close to about 16 times, 17 times next year earnings, actually pushing up a little bit higher than that. In actual fact, 19 times at current valuations, 19 times 2014 earnings. Now that's only allowing for about 5% earnings growth. I've spoken in the past that I think Origin can return to sort of 10% plus EPS growth, and in particular as we get into 16 and 17, Origin I think is the real star performer out of the LNG plays. I think from a valuation standpoint, Origin could have up to 50% EPS growth from current levels over the next 3 to 4 years. But short term, if you look out across the next 12 to 18 months at 19 times next year earnings, Origin's expensive on a 3.5% dividend yield. Our strategy here is we predominantly ran a stock repair strategy, so our effective exit prices we're getting out at around $14.50. I think that sort of caps the upside story for Origin just over the next 6 months. What else do we have? We have Stocklands in tomorrow's expiry. Again, this is a name that we purchased at lower levels. I spoke last week about Mirvac, and we ended up Mirvac hitting our target, and I'll jump to that in a moment, but remaining focused on Stocklands. So the company should deliver about 8% EPS growth, trades on about a 5.5% dividend yield. The risk here is they have a 100% dividend payout ratio, but I think the recovering property market in Australia supports the earnings picture for Stocklands. We continue to like the name. The stock goes ex-dividend in December, roughly around 12 cents. So whilst we're owning it at lower levels, we'd capped it out around the 370, allowing for the call premium that we collected. We got an effective exit price of around 380. I think that's about where support is, but I could see the stock tracking sideways and then moving higher in the early part of New Year. So we're happy to consider continuing having long exposure to Stockland. Also, Transurban's another name. So around, we own again at lower levels at around 675. We've capped it out into tomorrow's expiry. We receive reasonable premium for those positions, which provide an effective exit price for us close up to where market valuation is. Again, this is a stock that goes ex-div later this year in December. So whilst we have some clients capped out up here at around $7.77 to $7.25, I think that's really sort of the top valuation argument into the early part of New Year. So again, one of those names that we're happy to keep exposure to, reset those positions and try to recalibrate that call level back up to around 7.25 into the early part of the new year. But given that we own it at lower levels, it's provided a good return. Transurban, and it's largely traded sideways now for around 4 or 5 months, and I see more of the same, albeit I do think that as we get into the December period, the stock could push up to around that $7 level. Wesfarmers, so I spent a bit of time on this last week at around 17, 18 times next year's earnings. 18 times next year's earnings. The stock's reasonably expensive. It trades on a dividend yield, forward dividend yield of around 4.75%. We'd capped it out at around $43 into the end of September, so we wouldn't expect to have to deliver that stock, and we'll have the opportunity to reset those calls into the early part of the new year again. Also, Woolworths is a name that will have an option expiry tomorrow, so we own it at lower levels down here. We're predominantly capped out around this $35 level, and when you consider that in the context of the stock trading 18 times next year's earnings and on a 4% dividend yield, I think we're sitting sort of roughly at a range where we'd expect Woolworths to consolidate and move sideways. Finally, Woodside Petroleum. So we're sitting on the right side of this. We're up at around this $39 level for options expiry for tomorrow. Again, we own the stock at lower levels, so if we are delivering it, we're banking good annualized returns. All these names that I've spoken about, approximately we're deriving roughly 10% cash flow as a combination of the dividend and the call premium. If we are to be delivering the stock under the options that we've sold, we're delivering in excess of 20% capital return on those positions, which meets our sort of target for the positions that we set in the market. In the case of Woodside Petroleum, the stock trades at about 13 times next year earnings. It's on about a 6.5% dividend yield. The company should deliver between 10 to 12% earnings growth into 2014, and I think likewise that the stock, whilst expensive at these levels, we'd expect it to consolidate and move higher or move sideways, and then into the early part of the new year we'd expect to see a stronger performance out of most of these resource names. We continue to like Woodside Petroleum and BHP, albeit with the stronger iron ore prices we expect earnings upgrades for Fortescue and Rio as well. And then finally, to conclude in today's short form webinar, Westfield Retail. So we've been owning this name at lower levels. We've been waiting for the stock to move into our target of around 305. We'll look to sell the calls at around this sort of 320 level into the end of the year. We'll collect the dividend in the December period. Westfield, not expecting too much in earnings growth over the next 12 months, but at roughly a 6% dividend yield, the stock's well supported at or near this $3 range, and the company still has a little way to go with its share buyback. And just to have a quick look at the Mirvac Group, which I'd spoken about last week. So again, this is a name that we own at lower levels. We had a sell target there of 178. It hit that during, I think, late last week, and we've taken profit on that, delivering roughly a 20% annualized return on those funds that were deployed into the Mirvac position. That was really the only trade or position that we managed during the course of the week, but obviously with option expiry coming up tomorrow and the list of stocks that I went through, there'll be a bit to report in next week's recording. To conclude today, again, just with that quick summary of the XJO. So our base case is that 15 times earnings, 4.5% dividend yield, equity markets are well supported, central bank policy should lead to pickup in global GDP growth. I think we can be reasonably comfortable that it continues to make sense to have a overweight exposure to equities. I do think that a lot of these defensive names that are growing earnings at sort of 5 to 7% are expensive, as I've mentioned, trading up 18, 19, 20 times next year earnings, getting down a sort of 4% dividend yield. I think it makes sense to own those names and sell the covered calls to drive the extra income and extra returns out of the individual positions and across the portfolio in general. Thank you for listening in. I look forward to speaking again next week.